You know, a little
Do you teach? What other classes do you teach?
teach some evening classes. Uh,
This is your only day class?
yeah, they just offered me this day class this semester. So yeah, this is the only one. I used to teach some day.
So
Just
like the night one's better.
either way, it's just like being the night is mainly virtual, so you don't have like you're not. It's like you feel distant from the students. So yeah, I like this one better, I suppose. I like in person better. So here we go. So again, we're talking about Jesse Wells. He's like a folk singer. They call them the modern day Bob Dylan. But anyway, we've been looking at a lot of these financial calculations and things like that, future value, present value. And I was looking it up, and I remember I thought I'd heard George Carlin. Anybody ever heard of George Carlin? Like a comedian, old comedian. But anyway, he said something about how the varying jargon, the jargon of the stock markets and financial markets, you see a lot of formulas and codes and things like that. And so one thing I'm trying to do is create our formulas that are based upon what we learned before. Because if this particular section, homework 7, will lead you down a path of many different formulas with many different variables. So what I've tried to do with this one here today is make it into more usable formulas for us. So Jesse Wells, there's this song. It's called "The Poor." See, I gotta get it to scratchy voice. I gotta get the tune in my head. I missed the class where they taught the rules. I was memorizing capitals. I was in the spelling bee. I must have missed the part where they taught the art of private equity. I was selling chocolate bars. And then it goes on and on. Thank you. I'll be performing never. Okay. So you get the idea, like, the reason why I said this is like, hey, there's certain people, hey, it looks so complicated. Maybe they're doing that to make it complicated so they confuse you or whatever. But anyway, that's the idea. And, some people, like the MBAs, right? They know this stuff. So, but, anybody sell chocolate bars in grade school? No, I don't know if they do that more. Girl Scout cookie, yeah. So, see, that's our idea of business, right? When we're growing up. But it's all based upon what we would call equity, private equity, equity value, and always these calculations and numbers. So I wanted to show you, like, here's simple interest. What kind of function is simple interest? Look at the graph. Yep, that is linear. Now, so let's look at this annual percentage yield, right? Remember, it's like 1,000, and then you apply your percentage, then that compounds, right? So see how it starts off fairly slow, but then it starts to rise, and then as it should continue to, rise like that. But here's one thing, when we start talking about averages, let's just take a few data points here. Like if we just had these data points, what we would do, we would sum up the averages, right? And so how many data points do we have? 1, 2, and a 5. There you go. So we would take those data points and divide it by 5, right? That's an average. But you can see how it fluctuates. But this is a fluctuation annually, right? Annually. So that's when we start talking about average, we're talking about something constantly being evaluated. Your loans, your savings plans, those things shouldn't fluctuate. But anybody ever watched the stock market lately? It's fluctuated, right? So what do we do? What do we measure? Well, we just measure over time. And we'll look at some stock numbers. We'll see a beginning and an ending, a closing cost or a closing value on the stock market. So that's a beginning of the day, right? I think they open at 9 a.m. So I'm thinking of the Dow mainly. 9 a.m. New York time and closes at 5 New York. So beginning value on the stock, everybody bids, it goes around, 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 and then it ends up over here. Hopefully it ends up like that, right? So that's the idea to help us visualize these types of things. So there may have been one other thing. And then and so here's a big formula, and we talked about it a little bit, where you've got the M, and that's your monthly payment. And I have to admit, when I was buying a car or something and I needed a car really bad, all I thought about was my monthly payment. Because I got to survive. I got to get to work. I can't do anything, right? Unless I get that motor scooter. I do have a motorcycle, but it's not convenient to carry bags around, right? And see here, this is where I was going. And this is what I talk about is we got these different variables, different systems. See, notice this is the payment. M is represented in Excel up here. What do we have here now? More variables, right? The question is, that is R. This one's a little weird. We'll talk about it. But anyway, what is FV? Future value. This doesn't tell us what it is in Excel, but what is P? Principal or present value. So I'm going to try to make some formulas based upon FV and PV, present value and future value. So that's where we're going here. And that'll kind of help you a little bit. This is not true, I don't think. There's something else being calculated in Excel for NPR. And there we talk about periods. So I think what we're talking about here is if you have a savings plan like we had, for example, where you had periods where you paid, but you had an annual return, and how we broke that up in the table. But anyway, that's what I wanted to get started on. So there we have, and then I've got a couple of links in here. And one of them goes to similar problems to what is in the homework set. And this may take us a little while to get through, but once I show the pattern, we'll be good to go. Any questions, concerns about the test coming up? Take-home test. Yeah, just keep working on that as we go along. So here we go. It says compute the total and annual returns. Compute the total and the annual returns. So remember those definitions we had, right? We had those definitions, total return, what else, annuity due, ordinary annuity, remember all those things. So I want to show you this one. say if you were to type this in the AI, it would give you yet another formula, right? Another formula, but let's use the ones we've used before. Does anybody remember N minus O over O? Does anybody remember that one? N minus O over O. What was N? It's a new value. So what was O? Old value. And also that one right there. So you might see, oh, there's a lot of different formulas out there, and you got to use this formula for this problem. Why? We learned this one, and we have our little, what do you call that, mnemonic device, N O over O. So in this particular case, on number 18, and then we would multiply that by 100, right, to get it into a percentage. So what is N in this situation? You buy the stock, you bought 200 shares at 25 per share, and then you sold it for 20. How can we calculate? Well, what's the new value? The new value is right there, isn't it? So let's just use it as a 20. We'll get, it's a ratio, so it will work out. So what's the, oh, sorry. Let me do it as we were doing it before. So N equals 20. What is the old value? How could we find the old value if we got 200 at $25 a share? Multiply it. So there we go. How much was it? 200 at 25. And that's 5,000. Oh, you can't see my screen there, sorry. So there we have that. We got 5,000 there. So it would be 20 minus 5 over, what would be on the bottom? 5 times 100, that's 15 over 5 equals 3 times 100, which is 300%. So that was easy. And you don't get caught up in any other formulas. You just got your N minus O over O. And I know Ella was a big, where's the formulas? I was trying, that's what it kind of thing. It's like, man, I don't want to just give them a whole bunch of formulas. And then you're like, I don't know what to use. We can try to refine them down to the formula. That way they're not overwhelmed. That's where I had a brain freeze on this class last time at one point. This section where there were new formulas being thrown in there. So I don't want that to happen to us. Or I don't want it to happen to me again. And I certainly don't want it to happen. So then, so that was, what do you think that is? Total return or annual return? Yeah, so that's your total. Be cautious as we yeah, but and of course not quite. Not quite. So close. Luckily that wasn't an innocent bystander. Luckily Charlie wasn't sitting over there. Good thing, good thing. You got to count your blessings. I should go on for the trash, by the way. I'll go. I should have called my shot. Anyway, here we go. So now we want to get the annual return. That's another thing, right? That's another variable. But you know what annual return is in this formula? I'm going to rewrite it this way. So actually, annual return is the R. Think about it. All we're doing, we're investing money, we're getting payments, or we're borrowing money and we're making payments. There's interest, there's a jump, there's a price. So these formulas really are just the same thing of the same thing over and over again. So I'm going to solve for R. And I will find a formula here. So notice I'm going to take both. Well, the first step would be to divide by PV, right? The present value. So we got future value over present value. And then we got 1 plus R to the n. How did we solve problems that for an exponent? Like if it was x squared, how did we undo the square?
Sure.
So, and remember, square root is the same thing as taking a value to the half, right? That's the same thing as square root of x, right? So if we take both sides here to the power of 1 over n, what's going to happen to the n over here? Remember power to a power? So we multiply these. What's n over n? N divided by n.
1.
So we got future value over present value to the 1 over n equals 1 plus r. Now, so how do I solve for r? Subtract the 1. I'm just going to move it this way. So now it's future value over present value to the 1 over n minus 1. Remember we saw all those minus 1s? What they're doing is shaving off the growth factors, the integer on there, and only dealing with the decimal part. It's called something fancy, but I can't remember what you call it. But anyway, it's a minus 1. So now all we got to do is put in our variables. Right? So it's future value equals the 20, right? Present value was how much we paid, right? Which was 5,000. And so we put this in. We're trying to find the rate, future value 20. Since it's a ratio, I can shave off the numbers there. And then, did it say anything? Is there any mention of a years here? The 5 years. So, n is 5 minus 1. 4 to the 5th. I don't know, it's one of those. I better keep it into the actual numbers because that ratio is not going to work as I take the root out. So let's put in the actual numbers, 20. I was trying to shortcut it. Not a good idea. So let's calculate this. Let's go to Desmos to calculate it. Don't worry, all. We will conclude a little early unless anybody objects. Oh, it's the ghost man's got an objection. Ghost man in the corner. You ever got you play softball that way, right?
Go stand on first.
When you only have like 3 players, so you just have a ghost man, and the ghost man can never steal. He went. He stole. No, he didn't. He didn't. Okay, 120 and 5,000. How do you get to an exponent on Desmos? How do you raise something to a power? It's this key right here. That's the caret. GMT, old school.
Is that the arrow?
Yeah, and it's right above the 6, so shift. And so I'll hit that, see it went up. And then I need a fraction up there, right? So I hit the slash bar. Watch this magic right here. See how it made a fraction? 1/5. And see how we got that 1? Remember I said we're shaving off the 1 just so we have the rate. Remember, there we go. It's not a truncation. There's a fancy word about it, like where you do that. I can't remember. You save off the integer. Anyway, there's our answer. Multiply that times 100, and what do we got? 31.95%. Look at our choices. 300. So, like, if you were confident, you could probably go ahead and make, like, if you, I don't know how to get this. Like, if I'm taking a test, like, hey, I this knows 300. Yes.
Like on the test, like we just get the first part, but maybe we forget.
Yeah, I kind of take that. I human stuff. I human grade, not computer grade. So now, oh, they got half, so that's half the credit. And I think about that every time I. And like if you showed the work and what you were thinking, what you show your work what you were thinking, then I would, that'd be more than half because you tried. Why shouldn't you worked hard, so you should get something for that. You're thinking that you're a student, that's your job. Other than the other 3 or 4 jobs and the sports and the clubs and the everything else. But anyway, does that make sense? So right here, you can see a way to find the rate formula, right? We've used this one before, right? What was future value? What do we use typically? I always say annuity. So A, that's your P. So these are the same, only different interpretation, but they, but don't get lost. That rate is a rate. How much did you make? Let's try this one. I think now that we have the formula, we can plug and play this, and I'll shift over to my wonderful notes and see, LF, you're looking for formulas. I'm going to start trying to code them with the blue marker. So like if you look through these notes, see there's that one. And then there's the N minus O over O. So that way you don't have pages and pages of notes in form. So here we go. 19, complete total and annual returns. The described investment, 600 shares of XYZ stock, $40 a share. Sounds like a good deal. I have no idea what XYZ is. Evidently, they deal in X, Ys, and Zs. That's a good deal for $40 a share. So, you see, using the N minus O, and that's total return. Total return is N minus O over O times 100. And there you can see down here, we calculated the rate. We got future value. And here, that's how much we bought it for, right? The $40, and we bought 600 shares. And the new value, what happened to that stock? Sold it for, and how much did we pay? Oh no. Oh no, we lost money on that deal. So don't take the advice of me when you're looking for XYZ stock. That didn't work out. Notice the negative signs. Negative sign is really just an indication of a direction, if you really think that. take a look. And I'm going to go through these. There's slight variations as we go through these. Again, the N minus O. This is number 20. 5 years. Here's the go. Here's the goal. 5 years after paying. So what's the present value? Or the see how that is the old? Because it's 5 years after paying. So that's the old. And then we sell them for 5,000. That was easy. That was clearly, we have the new and the old right there. We can just plug and play future value. But here's the thing. So if you read this like this, I've sold the stocks today, what do you automatically think? Oh, that's the present value, right? But it's not. We're comparing from a previous amount of previous time. So see, notice how the future value is what we sold it for. Right there, see? And then the present value is what we bought it for. So that can be a little tricky as well. Present value in this particular case is the old. And also notice that I put the new, that makes sense, right? But not when we're talking about future value and we're trying to get that return. Same thing. Same thing, right? Okay, here's what Jesse Wells was talking about. These codes and numbers start to get kind of overwhelming. We got R's, we got PVs, we got FVs, we got I, lowercase i's, we got uppercase i's, we got T's, then we say it's X. Sometimes we say it's X. But anyway, look at this one. This one is it says compute the total and annual returns on the described investment. 7 years after paying $7,275 for shares in a new company, you sell the shares for $11,030. What we got here is these concepts of private equity, corporate equity, the fuel, the mechanism, the thing that makes capitalism run, right? So we have a PE ratio. It's a price to earnings ratio. Don't worry about that. Just know what it is. It's actually, I'm going to call it earnings per share. That's another name they'll throw out there. Earnings per share. That makes more sense. PE, earnings per share. That makes sense for me. So I'm going to use EPS. And here I'm going to use this price per earning here. Notice it's stock price divided by the earnings per share. Stock price, earnings from share. That is 22, isn't it? Or did I jump one? Oh, we just did 22. I'm catching it. So this is what it'll do. It's going to give you this, but it's going to give you a table of ABC stock, like a stock chart, a stock chip chart, where you just have the listed stocks, and then it shows these percentages, and everybody gets confused, and then they say, okay, broker, I trust you. Just tell me what stocks to buy. Then his boss sells some stock, and then he comes to say, this is stock. Notice the PE ratio. 13. The earnings per share is what it's asking. How much profit per share? Profit per share. So this is the thing. We know the profit per share is 13. We had 17.75, and that is close. But of course, it's got your yield and the high, the low. That's the thing. It's going to try to trick you into using, well, not try to trick you. It's just one of those things. The high. What's the high? What would be the high? What's the meaning of a high if a stock's trading all day? So like its peak. Does that tell us anything about what it started from, what it closed? What's the low? But that doesn't tell us anything start or end, right? So that's cool to see that it. One thing, what valuable information could you gain from seeing that a stock varies a lot per day? Would you think that would be trustworthy? What's that? Yes, and who knows what it'll do. It might be a sign of some insider trading of some sort. So you may not want to invest it. But like if you modeled it, you kept tracking it, you might be able to see a pattern. And while everybody else is scared of this one because it fluctuates so much, you might be able to gamble and make some money. But none of that is what we're asking, what we need. But what we need is the close. Notice what it started. It doesn't even have I thought it had usually they'll say a start or a beginning value, and you can see, but I don't see it in that. Also be careful. So like it'll have this, and it also might throw another stock sheet. So you don't want to, you want to make sure you use the right stock. We're doing X, Y, Z. So net change, that's over today. So we can find the start and the beginning from that. Because we could go down 0.09 from the close. So we could gather that information. 1775, is that all there is? That's that easy. With that formula, and I should, there you go. There's your formula. That's your formula. And all you need to find is the close. And then we had the PE. There it goes. Does that make sense? So I think, but like just as a distractor, the multiple choice game, it used ABC. I didn't put ABC on my HTML version. I didn't want to, I could have, but you'll see it. So that's where they got the $1.45. And somehow they use some other, see, they're just throwing numbers at you, right? They're just throwing numbers at you. So that's where you could put in the wrong ones. And I know I don't want to insult everybody's intelligence, but close and PE, close, PE. No, yeah, close, sorry. Close, PE. My eyes, you get the idea. That's all you're looking for. But see, so much information in that question. So Friday we'll do treasury bonds. We'll do treasury bonds because those, you want to go through those problems in your homework and hammer out an algorithm, find a formula that works for you. But let me tell you, that's exactly what I did there. And I'll give you a hint to where we're going with these bonds. Let's just take a look at one of these bonds. It jumps way ahead. These start to get pretty interesting. So calculate the current yield. Current yield, there's another term. There's another term. Current yield. With a coupon rate of 4%, that has a market value of $850. So if it's if it's $1,000 bond, why does it have a market value of 850? Current market. What are people thinking about that bond? Right. Usually some of them you can buy for the discount, and then so like you could buy $1,000 for 870 or 850 and then get 1,000 after sale. But when we look at all this, here's your formula. Current yield, annual coupon payment, current market price. That's your current yield. Coupon rate, 0.4. Payment. So if it is giving a 4% coupon rate, that's 4% on $1,040. There's your coupon rate. So we're going to start putting in our numbers. Current market price. Current market price. Here's my formula for it. CY equals ACP over annual coupon price. I refine these a little. Current market price. CY current yield. And see how there's what we end up with there. That's where we have a difference between the coupon rate and the yield. See, we're making a little more money, a little bit more money than what the coupon rate is. So we'll continue on with these bonds next time. Anybody have any questions, concerns? Would anybody like me? Does anybody have a request for a tune to sing?
Everybody.
So you don't want me to sing another song? Is that what you're saying? All right, I'll see y'all later. Have a good day. Keep.
I won't be here on Friday
Okay.
because I am my brother's
Hold
birthday.
on a second. Let me stop recording.